we tend to view bonds as a lot safer than stock. And it's almost always true because stock, it's a higher risk, but you tend to have a higher return when life is going well. Bonds tend to be a lower rate of return, but the risk is much smaller unless you start playing games with like bonds that are low rated. Typically, a bond rating, if you have a triple A bond, which is the best you can have, or a double A or A bond, those are all good, even triple B and double B. But once you start getting single B or C rated bonds, then they're riskier bonds, and there's a chance you might lose the whole principal that you invest in the whole process. So let's look overall on all the risk about bonds. They're normally considered pretty much a low risk investment, but there's a number of risks. One is a credit risk. Okay, there's a possibility that the bond issuer will default on its debt obligations. This is the highest risk of all bonds. And you hold on to the bond till maturity, and then the person goes belly up in the process. You're stuck and you're out the money. It's gone, and almost no chance of getting it back. In theory, bankruptcy court and yada, 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 the whole thing, except for the fact that reality is the chance of you getting that back is slim in the process. Yeah, you might get something back, certainly not the whole thing if they do go belly up in the process and go bankrupt. So that being said, sometimes they can't make their interest payments or repay their principal amount, especially in times of high inflation, where all of a sudden people try to buy their bond. It was a lower rate because what it was previously issued at. So you have all these different parameters out there. So life can be tough. Credit risk is the number one problem with bonds. Secondly, is you have the interest rate risk. This is the big deal. Now follow this closely. The interest rate risk is a risk that the value of the bond will decline if interest rates rise. Okay, you buy a bond. You're holding on to it because you're a smart investor. It's the third year you had a bond, and the bond's going to mature in 17 years. You're probably not going to keep it the entire time. So that being said, you have the bond. You bought the bond, and it's a 7% bond, and you have the $10,000 principal sitting there, and you're waiting for it and everything. So all of a sudden, the Fed decides, yo, let's get together and hang out, and let's have a party over there in Wyoming and Jackson Hole, and we'll sit down and we'll have fun. We'll have a good wine and a bourbon. And then, you know what? Let's raise the interest rates. Yeah, let's go wild. Let's go 0.5%. Well, we just want 0.5% next month, and nobody will notice. So they raise the rate again. And all of a sudden now, the most recent bonds issued that year, you bought yours 3 years ago at 7%. Now, the bonds a similar size, similar companies, similar risk, they're paying 10%. Well, guess what happens to yours? The value of your bond drops because it's a lower interest rate in the process. You have an older bond, it doesn't match because you have a higher inflation in the economy. It doesn't match that. So your investment drops in value because of the current stuff is being issued at a higher rate. This is a pretty serious problem too. No, it doesn't threaten your principal, but it certainly does threaten the possibility of you being able to sell that at a good price if you want to sell it early before the maturity date. Inflation is a big problem. We talked about this previously, how inflation is an economy destroyer. So we've gone from 1 and 2 and 3% interest. Now we're at 5, 6, and 7%. We'll see what happens. But by that inflation, it really reduces the value because the what you paid for it really will never match what it is if you keep on having inflation, especially over a long period of time. It's especially a problem, a risk for bonds with longer maturities, because you have no idea 30 years out what's going to happen. A lot of people will trade that bond in the secondary market and keep on scrambling them around, trying to avoid being the one that holds them last if the rate is too low. Liquidity is also a problem because you may not be able to sell the bond quickly or at a price that you paid for it because I need to get rid of this thing. It's an albatross around my neck, and you want to sell it, except for the fact if you sell it, you'll take a definite loss. If you hold on to it, the market may change. So the bond market is not as liquid as the stock market, and that's part of the safety, but also part of the problem. So liquidity is a problem. The call risk. Hello. I'm calling you. You have a bond. I want to pay that bond. I want to call it early, but I got a really good deal on the bond. No, I don't want to. Doesn't matter what you say. If the company has a bond and they want to be able to capitalize on it and they have the cash, they can actually, most bonds, not all, but most have some type of a call aspect to it. So the company can sit down there and bring the bond in before the maturity date on it. So call risk, they're higher, especially normally you have them all on high interest rate bonds. But that being said, the callable bonds, they'll redeem it before its maturity date, and you have to sit down and surrender it and get your face value back in it in the process. So that's part of it. So, and the reinvestment risk, okay, the risk that investors, they'll reinvest the interest payments at lower rates than the original, you have that problem as well. The exchange rate risk. I had a large loan, and the loan was in the bank, and the bank got bought out by a Japanese bank, and the totally different aspect of it. And there was some shifting inside the bank. Unfortunately, I was clear on the inside, but that being said, there was some exchange rate aspects between the American currency and the Japanese currency that might always be there. So always risk. But here's the common sense. We've talked about it. Diversify your portfolio. Diversify your bond portfolio. Have a lot of different issuer sectors, maturities. Invest in higher quality bonds. Remember, you're supposed to only have about 10% of your money invested in wild stuff. Okay, don't go wild on the bonds. That really should be the bouncer of your portfolio to make it more stable. Maybe go wild and make one or two junk bonds if you have a huge thing, but be careful because of the fact you might lose that in the junk bond, which would be anything rated B or lower. So that being said, invest in short-term bonds. Short-term bonds are less sensitive, and hold on your bonds until maturity. Okay, you might have to wait a long time to make that happen, but sometimes when you hold on and get the full principal amount, no matter what happens, the interest rates or the market value, you'll be able to collect the bond at its maturity level. So bonds, they're a good investment for many investors, but it's important to be aware of the risks that are involved. Always consider investment goals and risk tolerance before purchasing bonds. No, they're not as risky as stocks, but still, it doesn't mean that it's the same thing as a bar of gold or a government security if you're using corporate bonds. Take care.